听见资本本期视频为您带来的是摩根士丹利在4月17日亚太宏观闭门会，美国优先政策正在撕裂亚太经济版图。摩根士丹利最新内部会议曝光，关税大棒挥动下，整个亚洲将迎来同步经济及刹车。最新预测显示，2025年亚太地区 GDP 增速将直接砍掉 0.4%， 而风暴眼正出现在这个季度。未来3个月区域内经济增长将断崖式下跌 1.2%， 创10年最猛跌幅。最危险的信号来自企业端，44%的加权平均关税如同悬在头顶的达摩克里斯之剑，直接冻结了70%跨国企业的投资计划。中国和越南正站在风暴最前沿，这两个对美贸易顺差占 GDP 超 20% 的经济体正面临供应链全面重构的生死考验。分析师警告，若中美谈判僵局持续，仅半导体和汽车产业链就将蒸发3000亿美元市值。股市警报已经拉响，摩根士丹利将东证指数目标价横砍 13%， 韩国综合指数估值逼近历史冰点。令人不安的是，市场共识盈利预测仍需高 9%， 这意味着至少还有一轮血腥杀跌。外汇市场暗流涌动，韩元反常走强背后竟是企业紧急撤回海外资产的逃生动作。但这种人为支撑随时可能被 27% 的外资撤离潮击碎。真正的致命威胁藏在细节里。日本对华出口暴跌 65%， 引发供应链断裂恐慌。台湾科技巨头正秘密转移 30% 产能到墨西哥。而最令人背脊发凉的数据是，当美国实际利率每上升 1%， 亚太新兴市场的资本外流就会暴增400亿美元。黄金价格飙升揭示了更深的恐惧，散户和央行正疯狂囤积贵金属。中国私人黄金储备量3个月激增 40%， 这不仅仅是避险，更是对美元体系崩塌的集体压注。分析师透露，已有跨国企业在用黄金结算跨境贸易，这种地下金融趋势正在掏空传统货币秩序的根基。韩国即将到来的大选，日本陷入僵局的贸易谈判，印度尼西亚濒临崩溃的财政，每个时区都埋着新的雷点。但最可怕的警告来自研报最后一行小字，当前所有预测都基于关税不再升级的前提，而实际上华盛顿的制裁清单还在以每周200项的速度增加。接下来是英文会议的全部内容。如果您需要我的投研助理人工加 AI 辅助校对的中文文本，您可以在频道的 Patreon 上获取。
Good morning and good afternoon. Welcome to Morgan Stanley's Thursday Macro Webcast. My name is Daniel Blake. I'm on the Asia and EM Equity Strategy team, and I'm joined by really a panel of expert speakers across the region to discuss the Asia Pacific impacts of the America First policy, as we've seen with reciprocal tariffs being introduced, being refined, reprieves being granted, but at the same time tariff increases on China coming through. So a lot of noise to work through, but some real economic damage unfortunately being done by this policy uncertainty and by this reset. So we have reset the economic and market outlook right across the Asia Pacific region. New forecasts on growth, on policy, on equity markets, and key trades as well from our macro strategy team. So joined in speaking order by Chetan Iyer, our Chief Asia Pacific Economist, Jonathan Garner, our Chief Asia and EM Equity Strategist, Gek-Teng Koo, our Head of Asia Macro Strategy, Chloe Liu is going to join from our China Equity Strategy team. We've got Jun Sok, our South Korea Equity Strategist and Head of South Korea Financials Research, and Sho Nakazawa, our Chief Japan Equity Strategist. Please note this webcast is for Morgan Stanley's institutional clients and financial advisors only. It's not for members of the press. So if you're a member of the press, please reach out to us separately, but disconnect now. And please do ask questions at any point. We'll look to probably put them in the middle of the presentation to speakers as they come up, and we can always take further questions at the end of the webcast. So without any further ado, let me pass to Chetan to summarise how you've seen the outlook from here, the forecast changes you've made, key conviction calls on who's likely to be able to strike deals first off the rank, who's more challenged, and then ultimately where you see a relative resilience and relative exposure to this new macro regime. Thanks, Chetan.
Yeah, thanks, Daniel. So as we sort of put out in our report earlier this week, what we are saying is that you're going to see a sharp synchronous slowdown in the region. We've cut our full year 2025 GDP growth by 40 basis points, but we already had some decline in growth because of tariffs on China before we did this round of tariff-related growth cuts. And so I would suggest to look at just the quarterly trajectory. And so as you can see from this chart on the left-hand side, we are forecasting about 120 bips deceleration in regions growth over the next 3 quarters. And the steepest slowdown or the downtick is going to materialize in the quarter that we are in right now, which is the second quarter. And in terms of sort of the way we've cut the numbers is it's in terms of deceleration, I would say, is most for China and other mid-size, highly trade-oriented economies. And the ones which are seeing a less deceleration in growth are India and Australia. So that's the quick rundown on the numbers. In terms of the key reason why we are doing this is, I know that there's a lot of focus on the bilateral deals, etc. But from my 2018 and 19 experience, I think the biggest reason is the uncertainty that gets created in the corporate sector's mind and the damage it does to corporate investment. So that's sort of the main driver to our assumptions and forecasts. Now coming on to just the tariff level, taking a stock where we are, tariffs are now at 44% for the whole region in terms of weighted average. And this was just 4.8% in January 2025. So we've seen a significant rise in tariff. In terms of outlook for this tariff, we are expecting deals, and we are also expecting some kind of beginning of conversation between US and China. And we think that whenever that discussion begins, the first step would be to take out the tit for tat tariffs. And we think that as the discussions continue, reciprocal tariffs, the original reciprocal tariffs will still stay. And that's why we have China weighted average tariff going down to 71 first by end of this quarter, and then going down gradually to 45 by the end of 2025. And for the other parts of the region, we are expecting negotiations to continue right now, and deals should be done. But our framework has been that deals will be tougher for China and Vietnam. And as far as the rest of the region is concerned, we think that deals will be effectively possible, will be somewhat difficult for Malaysia, Taiwan, and one other mid-sized economy. But what will be possible to do will be deals with India, Korea, Japan, and Taiwan should be possible to do a deal. But the parameter that we are using to assess that the difficulty for some of the mid-size and the smaller size economy is what is the magnitude of trade surplus that the economy is running with the US. And on that parameter, right now, we think that Vietnam will find it most difficult. Its trade surplus as percent of GDP is 27%. And as far as the other economies in the region are concerned, the ones which are going to find it somewhat difficult, they have their trade surplus in the range of around 3.5% to 9%. So Thailand is the one which I was missing. So Thailand, Malaysia, and Taiwan have some very high level of trade surplus as percent of its GDP. So the negotiations will be somewhat difficult. Again, deals should be possible for them, unlike for China and Vietnam. And India, Indonesia, Korea, and Japan should find it relatively easier to do a deal. Just finally, in terms of the policy response, we think that you should expect more monetary easing in region ex China. And as far as China is concerned, you should expect more fiscal easing to help growth. But even with this fiscal easing and some potential deals being done, we do think that unless and until China and Europe are seeing a deal, you are going to see that uncertainty prevail, and that uncertainty will affect the capex outlook for the region, and therefore you should still embrace for a meaningful downside in region's growth. With that, let me stop there and hand over back to you, Daniel.
Okay, Okay, thank you very much, Chetan. So very clear new set of forecasts. And Jonathan, we've revised the outlook for earnings and ultimately valuations. So take us through how you're seeing this set up more broadly, and then the specifics of what we've changed and what could change for the better, and also where the risks are from here.
Yeah, so the bottom line is that we remain cautious and defensive. We're reiterating our Brave New World theme from the year ahead outlook, i.e. we're in a period of highly disruptive change. We made meaningful target price downgrades across our coverage, and I'll spend a bit of time on that and then a little bit more on signposts for a trough, the kind of things that we are debating with clients about whether there was a trough. Last week, again, the bottom line conclusion from that is we'd only have a low to medium conviction that a trough has formed. And then I think later on, Daniel, you'll go through the market and sector allocation update. So we cut our earnings forecast to well below consensus. That obviously flows, as it always does, from the views of our economists that Chetan just went through, Asia, but also what's going on in the downgrades we've been doing in Europe and US. But there are other things that matter for earnings at a macro level, including FX, where we have plugged in an even stronger yen forecast to 135, and then the macro inputs. And I do think lower oil cuts somewhat more bullishly for some of our coverage. But we end up with target price reductions of between 12 and 13% versus prior base cases. So these are quite meaningful and not something that we do lightly. And driving those, we also moved our multiple assumption lower by one full PE point. On the earnings side specifically, we're now 9% below consensus for EM, 5% for China, and 6% for topics. We have been asked a little bit about why we're further below consensus for EM than we are for China or topics. And that's got to do with Taiwan and Korea and their heavy weighting to global cyclicals, and in particular to semis, and in the case of Korea, to semis and autos. So if we then look at the new targets, 2,600 for topics, down from 3,000 previously, essentially low mid-single digit upside, and essentially flat or downside for the other indices, including Hang Seng and MSCI China. And if you zoom into the middle of this table that you can hopefully see, you can see our December 25 earnings numbers, essentially almost no earnings growth. And that's materially now below consensus. Consensus has started to soften, really in the last 2 to 4 weeks. The same applies to the S&P, but in our view, it has a lot further to fall. Now, in terms of the catalysts for going better or going worse, some of you would recall that during the 2022 sell-off, where we didn't ultimately have a meaningful global macro slowdown, certainly not as severe as we now expect, we looked at a number of signposts that one has used over many cycles in EM, a notoriously cyclical asset class, to try and judge whether in aggregate we had indicators that a trough was forming. And we've revisited that methodology. We found it helpful. I think clients found it helpful in September, October 22. And when it became convincing in early October 22, we did upgrade EM, and we did upgrade cyclical EM, Korea, Taiwan, and semis and tech. So I won't obviously wade through all of these, but you have the charts in the full note, so please do take a look at them. But the ones that we find kind of least compelling are analyst earnings revisions breadth. We have no capitulation so far, so this is a low score, 2. Our macro cycle indicators, with the downturn is just beginning, rather than moving through the down cycle towards some sign of repair. And also this issue about policy uncertainty. Certainly policy uncertainty is very high, but there's no sign yet that it's reversing back down again. So that's why they get to 2 for number 12. Many of the others are neutral, 3 sort of out of 5. Some of them are constructive, and the ones that are most constructive are some of the technicals and seasonals, like VIX, for example. We had a massive VIX spike last week. The dollar is important. Usually the dollar acts as more of a constraint for EM by rallying during a macro slowdown and a market sell-off. This time, the dollar is actually weakening quite significantly, and that gives policymakers in EM so much more flexibility. But I guess if you zoom out just from the EM space, it certainly is causing some question marks over really deep issues like the reserve currency status of the dollar, the behavior of US long yields and what that means for global equity discount rates, i.e. not just nominal but real yields. So yes, we've scored it relatively constructive that the dollar is weak, and it gives us more degrees of freedom for macro management in Asia and EM, but you need to be careful about that one. And then I would also mention the decline in crude oil prices and oil versus gold. I mean, we score this 4 out of 5. This is a classic sign of macro trouble and the flight towards gold and the decline in oil. And it is getting quite extreme, clearly. But it's not yet, in our judgment, reached a 5. So in aggregate, at the bottom of the table, we're scoring this 37 out of 60. There's a sort of false precision here ultimately, but we wanted to do something that's quantitative because we found it useful before. And we do mention in the note, if we get to like 45 out of 60, you'll probably never get to 60 out of 60. That's the sort of level where we would expect to get more excited about an actual trough. So again, the bottom line for us is we have only a low to mid-level conviction that last week's price action was the trough. And so we would stay defensive. I'll stop there in the interest of time and hand it back to you, Daniel. Thank you.
Okay, thank you, Jonathan. So before we get into the specifics of the market and sector preferences, let's bring in Gek here for more of our top-down views on how we're seeing the macro strategy set up and the outlook for FX in particular. Given this weakness we've seen in the dollar against the G10 FX peers, but less so against EM FX. But how are you seeing it within the region here, Gek?
Yeah, sure. Thanks, Daniel. So yeah, as you mentioned, actually, AXJ currencies have done very well in the context of the significantly weaker growth and equity outlook that Chetan and Jonathan just outlined. So if we look across all of G10 and EM, actually, Thai baht and Korean won have been the best performers after the Swiss franc, euro, yen, and also Czech koruna. Thai baht could make sense given that it's highly correlated with gold prices, but then Korean won really stands out given that it's usually seen as the bellwether for global trade, and there the outlook is weakening quite rapidly, right? So if we look at the relative performance of the currencies, the fact that it's the trade exposed ones that like Korea, Sing, Taiwan, Thai baht that's outperforming suggests that actually exposure to tariffs or slowdown in global trade is not the main theme driving AXJ currencies at the moment, outside of CNH, of course. So instead, the key driver of Asia currencies at the moment seems to be which economies have the highest potential to repatriate their dollar assets. So that's why we see the current account surplus currencies outperforming the deficit ones, because in a risk-off environment, people would think it's harder for the deficit economies to finance to attract capital inflows to finance the deficit, whereas the surplus ones could actually repatriate. But we do have some doubts over the sustainability of the Asia FX strength on the back of this repatriation theme. One reason is because the Asia investors don't actually hold a lot of US risky assets, aside from Taiwan, Korea, and Malaysia. So if we look at the Asia's exposure to US assets, it's actually mainly in US treasuries and less so in the risky assets like equities or corporate bonds. So I mean, of course, the fact that the investors are reevaluating the status of US treasuries as a safe haven could create some treasury selling as well. But then we're not seeing very strong evidence of that at the moment. And the pressure to liquidate might actually be higher on the risky asset side, which only Taiwan, Korea, and Malaysia have more exposure to. And the other thing to consider as well is this is just one side of the story, right? We also have to think about the flows for the Asia economies, given that the foreign investors could very well also pull funds from the region, given the market volatility and also the less need to do capex in a weak growth environment. So actually a lot of the Asia economies have seen healthy FDI and also portfolio inflows in the past few years. So they could also see some reversal there as well. And if we look on this front, then Malaysia and Korea, which have bought the most US risky assets in the past 2 years, they've also seen the strongest FDI and portfolio inflows from the foreign investors as well. So actually the potential outflows could provide an offset for the potential US repatriation inflows there as well. So this story around like currencies getting supported from repatriation, we do think that's just one side of the story. And if we think about more holistically the other side of the flows as well, then it might not be that strong. So we think it makes sense to use the resilience in some of the trade exposed currencies to add to this defensive trades. So we've maintained trades like short Taiwan against yen, as well as long dollar CNH call spread spread. And we've also added long yen against Korea now because of Korea's high exposure to global trade, semis, risk appetite. So we do think there's some room for Korean won to play catch up to the weakness that we've seen in the other risky currencies like Aussie and Noki, for example. And we also do see that Korean won tends to underperform in this defensive environment historically when US real yields, break-evens, and also equities go down. And the other trade that we think we've added as well is long dollar Malay, because Malay is one of the more exposed economies to tariffs with high goods exports to GDP and also a large exporter of semiconductors as well. And then I'll just briefly touch on the rate side. We do think it's quite clear the trend is for lower yields in Asia because of the weak growth environment and also the disinflationary impact from tariffs. So we do like to receive rates, particularly in the belly part of the curve, to get some exposure from the potential central bank easing as well as the growth downside risks. So we are looking for places which have less correlation to US rates as well, given that US rates volatility is quite high at the moment and our US rates team is also neutral there. So we do like things like receiving 5-year China rates, on the NDIRS side, receiving Korea 5-year NDIRS on any spikes in yields, given that the BOK pricing is still very modest. And we've also switched from long 10-year India government bonds FX hedge to long the 5-year point FX hedge as well, because we do want to benefit from the RBI keeping liquidity easy and also the weak global growth and the risk of more rate cuts there. So yeah, maybe with that, I'll pause and hand it back to you, Daniel.
Okay, thank you very much, Gek. So let me bring up some key exhibits here. So bring that all together into the market and sector preferences. For us, we do come back in this environment, given the trade uncertainty, given the impact of reciprocal tariffs and the risk to the cycle. For us, we look at the revenue exposure of each market to the US, but also the revenue exposure to exports generally, and we do see Taiwan and South Korea as most exposed, followed by Japan and Mexico and India also having some significant revenue exposure to the US. But when we're thinking about this, it does come back to China being a little bit more domestically driven. And if we pan back to the overall picture of revenue flows, because there's been so much focus on trade and tariffs, but if we look at the revenue flows across different markets, we can see here that on the US side, on the right-hand side, in terms of the revenues that Asia companies on the left are sourcing from the US, it's about 10%. So it is important, but it's not to be overstated relative to the second order impacts that we see for this slowdown that Chetan's talking about, the impact on inflation, on the impact on policy outlook, and ultimately growth and margins. So really we're going to be watching for the policy response in many respects, whether or not China steps up with a more significant stimulus program, which does look to be staged and phased. But we do see impact coming through. But for us, it's still looking at the first order impact of the most trade exposed markets, which does come back to Korea and Taiwan. But if we look now at where we've moved our market allocations, we have retained an overall preference for Japan, particularly for domestic Japanese equities. Valuations did move down to pricing in levels of support that we had seen in previous recessions. So we did have the most valuation support in Japan. Nakazawa-san will join with more specifics in terms of the outlook for the economy, for the policy response in Japan. But we do think the self-help that we're getting from corporate reform, capital management buybacks, and ultimately the domestic reflation had put the domestic outlook on a stronger footing relative to previous recessions that we've seen playing out globally. We also keep a core preference for India. So Gek mentioned the relative resilience for the rupee, but also the outlook for economic growth being more resilient as policy has already been inflecting more supportive in India. So valuations look expensive versus EM, but they have compressed in absolute terms, and we do prefer domestic-facing Indian sectors, including financials, industrials, and consumer discretionary. And then Singapore remains a key overweight for us, 100 basis points overweight in our major market allocation. We're still seeing attractive profitability versus valuations, steady defensive growth, oligopolistic sectors, and some hedge against either higher for longer rates through the banks or lower rates through the real estate sector. But really the MAS capital market reform initiatives continuing to play through. We see the family office seed capital coming in coming months, but potential for further actions as we see that review process being completed. So then in terms of some of the smaller markets, I did want to pick up on, or actually before we get into the smaller markets, so China being an equal weight for us. We have seen profitability in an upswing. Our colleague Chloe Lu is going to come through with some more details on this, and we've seen index composition reshaping in favour of some of the tech and EV champions, but we do have this direct US trade and tension risk, and we do think we're still in an escalatory cycle where there is no immediate sign of an off-ramp just yet. So to turn more positive, we'd need to see even cheaper valuations or that phase shift towards de-escalation. In terms of the smaller markets, I want to pick up on a couple here. Indonesia, for us, remains an underweight. It's one FX pair that hasn't really been moving up. So we have seen ASEAN generally, as is typical of the case in this moving into more of a capitulation phase or real global trade risks being discounted. ASEAN being largely domestic oriented for the equity space does tend to outperform, and a lot of valuation risk in the price for Indonesia, but we still think the outlook is still concerning on the lack of clarity for the macro agenda. On the fiscal profile, the growth initiatives, and we have got a relatively weak growth profile for Indonesia with its slowing to 4.5%. In contrast, we've moved Philippines up to an overweight stance. But you can see here in this framework, still retaining that key underweight on Taiwan, on South Korea, and ultimately on the semis and tech hardware space. So if we're looking at the summary, the recent changes on the sector allocation, we are keeping a number of key financials overweight. So one of the, I think, surprising elements, or maybe out of consensus view for us, is that we do see relative strength in balance sheet position, capital position, asset quality for financials, and we do like them in our favoured markets, Singapore, Chile, UAE, which is also benefiting from much of the 2030 initiatives for the UAE, and then for Philippines also being a relatively defensive market. So financials over semis would be one key recommendation. But then looking across the board, we just recommend outright defensive. So that includes gold, defence stocks, utilities, telcos, and staples. We've got an overweight here on Australia consumer staples, but we do think look for businesses that have got relatively certain high quality earnings and cash flows to support their position in portfolios, but outright defensive allocations from here. So I'll stop there and then bring in our next speaker. So we're going to turn next, I think, to Chloe Lu from our China strategy team to take us through what we've done on the China targets and what we're looking to from here.
Sure. Thank you, Daniel. For China equity strategy, currently we maintain our equal weight rating and cut our 2025 price target. Our new earnings growth forecast is revised down by 2 to 3 percentage points to reflect the outlook of a slower growth. And now we expect MSCI China to trade at 10.5 times PE by end of 2025. This is a 9% discount versus MSEM's target at 11.5 times PE. Basically, we think the higher than expected tariff hike and some potential non-tariff US-China tensions could curb MSCI China's outperformance. And there are three main reasons behind our cut in the price target. First is the slower macro growth amid the tariff headwind. Our China econ team revised down the GDP target in 2025 by 30 basis points to 4.2%. And secondly is the renminbi depreciation. So the central bank may maintain a modest USD CNY depreciation to anchor the market expectations, but they will allow a greater depreciation against other non-USD currencies. And our econ team expects the USD CNY forecast at 7.5% by end of 2025, and some front-loaded depreciation in the near term to 7.4 by end of second quarter of this year. And thirdly is that we think the potential spike of the China equity risk premium with the non-tariff US-China tensions escalations will be negative to China equity as well, including the overhangs regarding the 80 of them are included in the MSCI China universe. And among the 23 names, actually over 80% of them have already do the dual listed in Hong Kong. And this dual listing status generally guarantees that these ADR companies can still be traded in Hong Kong, even if they get delisted from the US market. And currently, the Hong Kong Exchange peers with market cap over Hong Kong dollar 10 billion, it can do the secondary listing in Hong Kong. So most of the ADR internet companies are qualified to do that. But in a delisting event, if it really happens, like particularly if all the ADR companies get delisted at the same time, we believe this would signal a significant escalation of the US-China tensions, and the entire China equity market could face valuation downside risk, as the equity risk premium will go up. And especially for the ADR companies without a Hong Kong dual listing, they will face a much larger downside risk. But on a 6 to 12 month basis, we think the valuation and the liquidity downside risk is more manageable, especially for the names which is included in the Southbound Stock Connect program. The mainland investors will provide the incremental liquidity support for these names. So with that, I will stop here and pass it back to Daniel.
Okay, thank you very much. So now, next, let's bring in June Sok, our South Korean equity strategist, to talk through positioning here. So we've had a lot of catalysts coming through both domestically and internationally, including the KCC ruling, the elections coming. But June, how should we navigate the next 3 months for South Korea?
Thank you, Daniel. It's going to be probably more of a roller coaster ride from here too, because the market has recovered after kind of almost breaching 2,300, but we think that cost is going to be range bound between 2,250 and 2,550 for the next few months. Now, the downside should be limited, considering that a lot of negatives have been reflected, probably more quickly than other markets. And also the government has been quite steadfast that, it will provide support if needed. When you look at valuations, very near trough level, 4P at 8 times, price to book at 0.8. If you look at foreign shareholding, it's down all the way to like 31.5%. And for KOSPI, and the most kind of recent kind of bottom was at 30.4. So not a lot remaining on that end too. So when you look at corporate earnings right now, we still do see downside. We have seen 2025 consensus OP being revised down 20% since last year fall, and a lot of that has come from the tech side. And obviously, there could be more, and we have reflected that in our target for our KOSPI target, where we think that right now consensus OP is probably around 8 to 10% higher than where it should be. But of course, when you look at Korea, there are other issues here, such as the CHIPS Act, the IRA impact, and obviously the semiconductor tariffs coming in. So it's really going to depend on how well Korea negotiates. And as Chetan has mentioned, Korea is one of the countries that has more room to maneuver. Now, I think generally investors do agree that Korea does hold cards for negotiation, which includes the shipyards to support U.S. naval vessel building, the LNG and infra support. Then we also have potential defense spending issues. But I think the key advantage for Korea is probably the fact that a lot of the conglomerates here are being proactive to be negotiating with the U.S. government, such as Hyundai Motors Group. I'm sure there's going to be more coming in. But, recently we've seen, President Trump and acting President Mr. Han have a phone call on April 8th. News is saying that the Minister of Finance is going to be visiting Washington next week to meet with Treasury Secretary Bessent. So, discussions are taking place. But I think, really, we do need to have the next president to do a lot of the heavy lifting. And there's going to be a lot of, trade deals and even like defense spending, if there's going to be changes there, that needs to be approved or ratified by the National Assembly. So June 3rd is obviously going to be a key date here. And a lot of the focus is now turning to the presidential elections. And while the June 3rd date is important, probably May 5 and 6 is also important because that's when the registration happens. And when you look back at 2017, when you had the presidential impeachment and also elections after that, the KOSPI actually rallied, and after the court confirmed the impeachment, and this is partly linked to an upcycle for the chips, for the chip makers, but also the leading candidate then, who became the President Moon, he pledged a lot of sweeping reforms, including like travel reforms, and this is well taken by the market, and this pushed up the costs, that pushed up share prices. So again, here, I think the key element here is whether there's going to be a leading candidate, and for now, there seems to be a leading candidate, and what the policy direction is going to be. And it seemed to be positive for the market, we could probably have sentiments pick up even earlier. So the policy message that we'd be looking for is going to be on obviously the pressing issues, which includes trade negotiations, fiscal policy, and the corporate reform plan. And once again, the corporate reform, the value up or the boost up that's being talked about from opposition party is also going to be a key thing to look for. And of course, for Korea, importantly, it's going to be how the chip cycle is going to move from here. And yesterday we had the news about the HBM side, where licensing requirements for shipments for H20 product to China and other countries could have some restrictions there. And on the traditional chip side, obviously we're still in a down cycle here. But our Asia Tech analyst Sean believes that we're moving faster, so the bottom could come quicker. But when you look at share prices, it hasn't really come down as much as in previous downturns, where share price came down like 40%. We're down around 20 right now. So conventional wisdom does point that overshooting is more the case than meeting the average. So just to end my part, I mean, Korea remains in late cycle, and we're looking for signs for a transition to early cycle. And some of the things that we need to look for, obviously, is a trade tension factor, but also monetary policy with Fed and BOK being important. Today, the BOK did not make a cut, but our economist Kathleen thinks that there will be 3 more cuts this year and terminal rate at 2%. More importantly, we're going to have to look at fiscal policies going forward, like a supplementary budget. And, that's going to be more, I think, for something that happens after the election. So we stick to our more conservative, view on the market and still remain defensive. Overweights are in communication services, where games and also internet looks a bit more interesting now than before, together with telcos. Healthcare, industrials, staples, and banks are where we want to be for now. So I'll stop here and hand it back to Daniel.
Okay, thank you, June. And the points you make there on valuations are also something that comes through our regional frameworks, where we did see Korea almost touching as well recession trough valuations, but not quite as much in the prices as what we've seen for Japan versus its own history, which does go to that relative preference that we have. And Japanese companies also having more of their revenues being sourced onshore in the US, maybe being a partial hedge, but again, we prefer those domestic. So Nakazawa-san, let's bring you in here on the topic of Japan. Take us through the new targets and your sector recommendations, key calls that you're making on the market here.
Thank you, Daniel. So I'd like to talk about 2 things: recent our topics target change and positioning recommendation as well. So yesterday we revised our topics target from 3,000 to 2,600 in our base case scenario with 3 reasons. So first, the downward revision of Japan economics team's growth outlook. Second, the late team's dollar yen target change. And the last point is a recent drawdown. And if you look at valuation assumption, EPS growth in the base case is expected to grow 2% at the end of 2025 and 8% increase at the end of 2026. The multiple assumes 13 times, which is below historical 10-year average, 14 times. Of the 13% downward revision of topics target in base case scenario, we factored in the impact of recent drawdown as 6% multiple downward revision. And as for EPS 6% cut both in 2025 and 2026, the impact of dollar yen target change from 145 to 135 was 4% cut, and the nominal GDP downward revision by 2% cut. And as for the impact of tariffs is based on the assumption that the 24% mutual tariff on Japan will fall to 10%, but the 25% tariff will remain as we factor in the growth forecast of the Japan economics team. Also, $135 yen assumption is based on the level of 2.75% of the terminal rate expected by our U.S. economics team at the end of 2026. And this assumption is factored in the risk of deterioration of hard data in the U.S. So we like to change the topic's outlook if not only nominal growth, but the dollar-yen assumption change is going ahead. So we revised down our topic's outlook, but the sector preference mainly for domestic non-manufacturing, which includes construction, software, retail, such as restaurant, discount store, or defense-related names, remains unchanged. If you look at analyst revisions, as left panel shows, foreign demand-driven sectors clearly revised down amid U.S. trade policy uncertainties. Then what's next? As we get closer to the May result season going ahead, we cannot rule out the possibility of more corporates not publishing guidance, mainly in the manufacturing industries, same as in pandemic. So I think it is likely to add downward bias to the analyst revision, especially on those manufacturing foreign demand-driven sectors going ahead. So I like to recommend to stay defensive position with Japanese non-manufacturing, which is our long-lasting recommendation, and it works quite well, even we are facing with huge drawdown overall, as we can see the right panel chart, which
the rest of the world as well. So our team is indicating that inflation in the U.S. could go up to 3.5% to 4% by end of this year, depending upon what tariff rates are settled. But as far as China specifically is concerned, I think there's definitely going to be some base minimum tariffs, as I was mentioning earlier, that is going to stay. We are realizing, and I guess probably there is a realization even in the US, that there is some kind of major supply constraint that is emerging, because if you look at the transport data in terms of freight booking, it is between China to US, it's down about 65%, so call it 2/3 volume decline. That's a massive supply side constraint that is emerging for the US. So we are expecting that these prohibitive tariffs will be brought down to a more reasonable level. But as I was mentioning earlier, it was still sticking at least the reciprocal tariffs which were installed in the first instance. So some downside to the US in form of higher prices will stay.
Okay, thank you, Chetan. And next question we've got is on the gold price. One, the correlation with the Thai baht, and also the outlook for gold here. So what we'll do is we'll bring in Gek here on the Thai baht correlation, and then Jonathan, if we can get your perspective here, because we do have a significant overweight on gold miners in our focus list right across the region. So maybe we'll pass first to Gek on the correlation, and then Jonathan on the outlook for gold and the role that it plays in portfolios.
Yeah, sure. Thanks, Daniel. So yeah, I think in terms of the correlation between Thai baht and gold, usually we do see a quite strong positive correlation. And the reason behind that is mainly because Thailand is a big gold trading hub. So usually what happens is when gold prices go up, then the locals might actually try and take profit and sort of sell off some of their gold holdings, and then they'll bring it back into Thai baht, which is why there is this positive correlation. Now I'll pass it to Jonathan.
Yeah, so gold and gold equities are interesting to own here for a number of reasons. We touched throughout this call on the weakness of the US dollar, and that's happening even prior to any adjustment lower in US rates. For some time, reserve managers have been increasing their holdings of gold in recent years. But what's interesting, I guess, this year is that retail investors, particularly actually in China, are making a step change function in their willingness to sort of hold gold as a hedge against geopolitical risk. In the gold equity space, some of the traditional major names have been relatively unable to expand production. And obviously, it's not easy to rapidly expand production in something like gold. And so some of the names that we're interested in across our coverage have a greater ability to do that and can therefore be more positively leveraged to the gold price. Thank you.
Thank you, Jonathan. And just noting, we did make some changes in our gold mining allocations this morning, actually, with Northern Star moving up to the top of the order of preference for our analyst Raul Anand in Australia. So we'll switch out of Evolution Mining into Northern Star, and also in the region, keeping Zijin Mining in our focus list across APX, JGM, and China, Hong Kong. So last question, a quick one for Nakazawa-san. A lot of focus on the Japan-US trade negotiations. We've seen the minister in headlines coming out of the Oval Office meeting with Trump himself. What do you make of the outlook for the current state of negotiations and key risks and events you're watching there?
Thank you, Daniel. It's a really important question. So Economic Minister Akazawa-san visited the U.S. and started trade negotiations with the U.S. from today. If President Trump himself participates in the meeting as reported, it seems that the true requirements from the U.S. administration might well come up with, but there's also a risk that the debate will not proceed with the unrealistic requirements that lacks economic rationality, in my sense. And the dollar yen could move toward downside given in the thoughts about some falling exchange policy. So potential stronger yen would be risk for Japan equities, in my sense. And the U.S. might try to be seeking cooperation by imposing tariffs on China at the same level as the U.S. on major developed countries other than China to escalate Chinese economic isolation. And the U.S. Secretary, Treasury Bessem has already publicly mentioned on Mexico and Canada with this issue, but Japan have a deeper economic tie with China than Mexico and Canada as well. And it is not easy for the government to accept it because it is clear that China will push Japanese companies and products out of the domestic market as retaliation. So if the U.S. stick to this point, it is inevitable that the U.S. and Japan trade negotiations will be prolonged and swamped. And I believe that is one of the major risks in my sense. Thank you.
Okay, yeah, absolutely. So to watch. And again, to reiterate, the $135 yen target from our FX strategist, Koichi Sugasaki, which again is pointing into our preference for Japanese equity exposure on an unhedged basis for those that are denominated in dollars or Hong Kong dollars, and also the preference for domestics over exporters. So thank you all for joining us for this webcast, and all the audience for joining us here. Wishing those celebrating Easter a blessed Easter ahead, and thank you. We look forward to having you join us next Thursday at 11 a.m. Hong Kong time for the macro webcast, and wishing you all the best.
Thank you.